Hello and welcome to Economy and World. Today we are not going to analyze the headline of the day or speculate about the next tweet that will move markets for a few hours. What we are putting under the microscope instead is the tectonic movement of the global financial system, the silent relocation of $2 trillion executed by BlackRock. While most retail investors remain distracted by the deafening noise of daily headlines and the volatility amplified by social media, institutional capital is quietly reshaping the global map of wealth. This is not a simple market fluctuation or a routine portfolio rebalancing. It may well mark the beginning of the largest wealth transfer of the modern era, orchestrated by the firm that effectively holds the keys to the global financial system, BlackRock. With assets under management approaching $14 trillion, this firm does not merely participate in the market. In many ways, it is the market itself. When Larry Fink and his team of analysts decide to move $2 trillion out of the United States economy and into emerging and international markets, they are not offering a suggestion. They are setting the path that smart money is likely to follow over the next decade. This capital shift is not an impulsive move or a reaction driven by fear. It is a surgical operation, built on advanced quantitative models and on a clear understanding that the long cycle of absolute dominance of United States assets may be approaching a point of both technical and fundamental saturation. To truly understand the magnitude of what is happening, we must strip away the mystique surrounding BlackRock and view it for what it really is, an unparalleled data processing machine. Through its Aladdin platform, the firm monitors a significant share of global financial risk, granting it a level of visibility no individual investor, no matter how sophisticated, could ever hope to achieve. That is why, when we observe a reduction in United States domestic exposure equivalent to $2 trillion, the real question is not what they are doing, but what their algorithms are seeing that the rest of the world still refuses to acknowledge. The answer lies in a combination of stretched valuations in the United States technology sector, persistent inflationary pressure that continues to erode the purchasing power of the dollar, and most importantly, a global leadership rotation toward regions that have spent years in the shadows of global returns.
The average investor operates under a powerful normalcy bias, assuming that whatever has worked over the last 15 years will continue to work indefinitely. We have lived through a golden era for the S&P 500, fueled by historically low interest rates and unprecedented monetary expansion. But capital, like water, always seeks the path of least resistance and highest growth potential.
Today, that path increasingly appears to be moving away from American shores. The fact that the German market has delivered returns above 20%, or that Japan has emerged from a 3-decade stagnation with performance far exceeding United States indices, is not a statistical anomaly. It reflects a true changing of the guard, one in which capital is now prioritizing real value and sustainable cash flows over perpetual growth assumptions that have long dominated Wall Street. This global rotation led by BlackRock is rooted in currency dynamics, a concept often overlooked by retail investors, yet one of the primary engines of institutional returns. When the United States dollar shows signs of weakness or structural saturation, assets denominated in foreign currencies receive what analysts call a tailwind. Investing internationally during a dollar weakening cycle allows investors to capture two sources of return: the appreciation of the underlying asset itself and the currency gain as the local currency strengthens against the dollar. It is a highly efficient strategy in which investors benefit both from company fundamentals and from the macroeconomic strength of the issuing region. This is the cheat code BlackRock is using to position its clients before the broader institutional market is forced to follow, driving entry prices higher. When we examine the specific vehicles absorbing this flow of capital, we find names that until recently were largely ignored by the general public. One of them is the VWO ETF, managed by Vanguard, focused on emerging markets. The investment thesis here is not merely financial. It is deeply demographic. While developed economies are struggling with aging populations and debt burdens that severely constrain fiscal flexibility, Countries such as India, Brazil, and much of Southeast Asia are supported by young populations, a rapidly expanding middle class, and digital infrastructure that allows them to leapfrog entire stages of industrial development. These countries are no longer just the world's factories. They are becoming its next major consumers. BlackRock understands that the next wave of global growth will not come from selling more software services into saturated markets, but from the urbanization and economic expansion of these emerging powers. On the other hand, the case of Japan and the EWJ ETF represents one of the most fascinating structural shifts in today's global economy. For decades, Japan was the textbook example of stagnation, a deflationary economy where capital seemed to go to die. What we are witnessing now, however, is a corporate great reset. Under pressure from global institutional investors, Japanese companies have begun to prioritize capital efficiency and shareholder returns, unwinding cross-shareholdings and refocusing on net profitability. With a historically competitive yen, Japanese exports enjoy a massive pricing advantage, while its industrial giants, from Toyota to Sony, continue to deliver a level of quality and innovation that the market is finally starting to value properly. BlackRock is not buying the Japan of the past. It is betting on a restructuring process that is turning Japanese corporations into cash flow machines built under Western standards of corporate governance. It is crucial to understand that this diversification does not imply a collapse of the United States, but rather a normalization of the global financial ecosystem. The United States will remain the undisputed leader in defense, artificial intelligence, and biotechnology, but stock market leadership is ultimately a matter of prices and expectations. When valuations on Wall Street already assume perfection, even the smallest deviation from expected results can trigger sharp corrections. In contrast, in emerging markets and across Europe, expectations are so low that even mediocre performance can translate into extraordinary returns for capital that entered at discounted prices. The professional investor is not looking for the company everyone loves, but for the asset with the largest gap between its intrinsic value and its current market price. Market psychology plays a decisive role in how these moves are perceived. Institutions typically accumulate positions during periods of calm or apparent disinterest, while retail investors tend to enter when a trend has become so obvious that it is already fully priced in. This timing gap is what enables the transfer of wealth. While the public reacts emotionally to headlines about tariffs, geopolitical tensions, or changes in political leadership, large firms use that volatility as cover to execute their most important purchases. Uncertainty is, ironically, the long-term asset manager's best ally, because it allows the accumulation of meaningful positions without aggressively pushing prices against their own interests. An additional layer of complexity and protection within this strategy comes from the revaluation of tangible assets, specifically gold and silver. The recent reclassification of gold as a Tier 1 asset for bank balance sheets has fundamentally changed the rules of the game. In the past, gold was viewed as a passive store of value, an insurance policy against extreme events. Today, for major financial institutions, gold is effectively equivalent to cash in terms of liquidity and collateral, with the intrinsic advantage that it cannot be printed by a central bank. This regulatory shift has created a structural source of demand that goes far beyond speculation. When BlackRock and other giants observe central banks accumulating gold at record levels, they understand that a new global liquidity framework is being built, one that relies less on sovereign debt and more on real assets. Any serious analysis of this great rotation must also treat politics as a catalyst of uncertainty, not as a final destination. Political figures, regardless of ideology, introduce volatility variables that markets dislike but professionals exploit. Rhetoric about trade wars or regulatory changes generates noise that is often resolved behind closed doors, yet in the short term, it frightens emotionally driven capital. The financial markets panic playbook dictates that negative news tends to be released during periods of low trading volume or when markets are closed, maximizing anxiety among individual investors. The following Monday, when retail investors sell out of fear, large capital steps in to buy that panic at an institutional discount. This pattern has repeated itself cycle after cycle and explains why wealth tends to concentrate in the hands of those who maintain technical discipline over emotional reaction. To navigate this new paradigm, it is essential to abandon the idea that investing is a simple buy-and-forget activity centered on a single national index. A multipolar world requires a multipolar portfolio. This means global exposure must be strategic and segmented. It is not about abandoning the S&P 500, which still contains some of the best companies in the world, but about recognizing that marginal growth is no longer concentrated there. The real opportunity to multiply capital lies in the sectors and regions undergoing structural transformation. For example, the energy transition and the growing demand for critical minerals are pushing economies that were once peripheral into the center of the global financial stage. BlackRock has identified that the infrastructure required to sustain the artificial intelligence era and large-scale decarbonization depends on resources that the United States does not fully control, forcing capital to flow toward global suppliers of these raw materials. The sophistication of this $2 trillion move is also driven by the need to protect against asset inflation. In an environment in which fiat currencies steadily lose purchasing power, owning equities in markets that are still in the early stages of an economic expansion cycle is one of the most effective defenses available. The tailwind concept mentioned earlier becomes critical here. If an emerging economy grows at 6% per year and its currency appreciates 4% against the dollar, a United States investor captures a 10% return before even accounting for the appreciation of the individual stock itself. It is a mathematical advantage that is difficult to ignore for anyone responsible for managing the retirement savings of millions of people. When we look at the rotation strategy, we see that the defense sector and rare earth and critical minerals are emerging as safe and profitable havens within this storm. Global instability, although tragic from a human perspective, generates a powerful cycle of investment in security and technological sovereignty. Governments do not hesitate to spend when it comes to survival or strategic advantage, which guarantees predictable revenue streams for the companies that dominate these niches. BlackRock positions itself in these sectors, not because of ideology, but because of contract certainty and the inelastic nature of demand. While discretionary consumption can suffer during a recession, spending on defense and critical infrastructure is often countercyclical. Another fundamental point that must be addressed is the difference between price and value, a distinction that becomes blurred during prolonged bull markets. Many investors are buying technology stocks at multiples that would require decades of uninterrupted growth just to justify current prices. In contrast, international markets offer companies with strong balance sheets, growing dividends, and dominant regional positions at a fraction of those multiples. BlackRock rotation is, in essence, a global value arbitrage exercise. They are selling what is expensive and overbought in order to acquire what is cheap and undervalued. It is the purest application of the principle of buying low and selling high, executed at a scale capable of moving entire economies. The structure of this wealth transfer also reveals an uncomfortable truth for many people. The financial system is designed to reward patience and information rather than frantic activity. Most retail investors check their accounts daily, reacting to every red candle with anxiety and to every green candle with euphoria. BlackRock algorithms, however, operate on time horizons measured in years. They do not care if an asset falls 5% in a single week, as long as the structural growth thesis for the next 5 years remains intact. This ability to absorb short-term volatility is what allows them to capture the compounding returns that truly generate generational wealth. In this context, financial education becomes the most valuable tool. Understanding that BlackRock moves are signals and not anecdotes allows a strategically positioned investor to stop being a victim of volatility and become a beneficiary of it. The key is to observe where the hands of the giants are moving, not to listen to what they say in public interviews. Official statements are often vague or designed to calm markets, but capital flows in quarterly reports do not lie. If money is flowing out of the United States and into Japan and emerging markets, that is the only reality that matters for anyone who seeks to protect wealth. The idea that certainty is the most expensive asset in the market is one of the deepest lessons of this analysis. When the evening news announces that it is now the safe time to invest in India, or that Japan has definitively returned, 80% of the move has already happened. The real profit is found in uncertainty, at the moment when the thesis is solid but overall sentiment is still hesitant. BlackRock operates in the shadows of reasonable doubt, using data to turn uncertainty into statistical probability in its favor. For the average investor, this means that the right moment to diversify is not when everyone is talking about it, but when technical and macroeconomic indicators show exhaustion in the previous model. We are entering a decade in which geographic agility will be as important as asset selection. The world is no longer a board where only one piece moves with strength. The rise of artificial intelligence, the reorganization of global supply chains, and the shift in monetary hegemony are creating pockets of opportunity in places that were once considered risky. However, in the current environment, the greatest risk is not the volatility of an emerging market, but the complacency of being invested only in a market that has already delivered its best results. The diversification implied by this $2 trillion move is an act of radical prudence. Finally, we must reflect on the impact of these decisions on the average citizen. BlackRock manages pensions, savings funds, and sovereign capital. What they decide affects the ability of millions of people to retire with dignity. For this reason, these moves are not speculative bets, but mandates of capital preservation and long-term growth. By following the trail of these investments, we are not only seeking short-term gains, but aligning with the vision of those who carry the responsibility of maintaining financial stability at a global scale. The great wealth transfer has begun, and the real question is not who has more money today, but who has the vision to position themselves where money will be tomorrow. The flow of capital into assets such as VWO, EWJ, and EM is not a passing trend, but a recognition that the world's center of gravity is shifting. As investors, our task is to stop looking in the rear-view mirror of past successes and start looking through the windshield toward the new frontiers that are opening. The economy and the world are changing at extraordinary speed, and in this environment, professionally processed information and the ability to act without emotion are the only reliable compasses. BlackRock has already moved its pieces. The board is ready, and the question is not whether change will occur, but whether we will be on the right side of the transfer when the dust finally settles. This transition toward a more global and diversified approach also requires an understanding of the financial infrastructure that supports it. The ETFs mentioned are not only ticker symbols, but gateways to thousands of companies operating in very different economic realities. By buying an emerging markets fund, you participate in the development of Vietnam's power grid, the banking system of Poland, and the technology boom of Bangalore. It is a bet on human ingenuity at a global scale. BlackRock uses these instruments because they provide the liquidity needed to move trillions without collapsing local prices, allowing a gradual and sustained entry. It is essential to emphasize that this analysis should not be interpreted as an invitation to panic or to indiscriminately sell United States assets. On the contrary, it is a call for sophistication. A smart investor maintains core growth pillars in the leading companies of the United States, while adding layers of protection and exponential growth through international exposure. BlackRock's strategy resembles that of an architect who reinforces the foundations while building new wings onto the structure. The old is not destroyed to make room for the new. The structure is expanded so that it can withstand the winds of change blowing from the east and the global south. The resilience of the United States economy is legendary, but even titans need periods of rest to digest excesses. The current level of public debt and the fiscal deficit in the United States are variables that institutions monitor extremely closely. If debt servicing begins to consume too large a share of the budget, the capacity for innovation becomes constrained. For this reason, seeking refuge in economies with cleaner sovereign balance sheets and real growth potential is not only an investment strategy, but also basic country risk management. BlackRock Capital is, ultimately, a barometer of global confidence, and its outward tilt should be seen as both a warning and an opportunity. To conclude this in-depth analysis, we must return to the central idea. Wealth transfers do not occur violently or explosively in a single day, but through thousands of small decisions and capital movements that, when combined, change the course of financial history. The $2 trillion that BlackRock has begun to rotate are only the vanguard of a much larger trend. In the world of global economics and finance, victory belongs to those who have the discipline to analyze data with professional detachment, the patience to allow investment theses to mature, and the courage to act while the rest of the world is still trying to understand yesterday's headline. The roadmap is drawn, the vehicles are identified, and the engine of the global economy is starting to move in new directions. Being prepared for this journey is the difference between being a spectator of history or becoming the protagonist of personal financial success. Well, that is all. If you found this analysis useful, make sure to subscribe to the channel so you do not miss the next edition of Economy and World.